Hello, everybody. This time we are discussing about institutional ownerships. Institutional ownerships refers to the ownership of shares in a company, big, large financial institutions such as mutual funds, pension funds, and hedge funds. These institutions typically purchase a significant portion of a company's outstanding shares, giving them a large stake in the company's success. Institutional ownership is an important factor to consider when investing in mid-cap stocks, as it can have a significant impact on the stock's performance. And then we move to the benefits of institutional ownership. Institutional ownership can provide several benefits to a mid-cap stock. First, it can increase liquidity in the market, as large institutional investors tend to trade frequently. This can help to stabilize the stock price and reduce volatility. Additionally, institutional investors often conduct extensive research and analysis before investing in a company, which can provide valuable insights into the company's financial health and prospect for growth. Finally, institutional ownership can attract other investors to the stocks, as it can be seen as a vote of confidence in the company's future. And then we move to potential risks and concerns. While institutional ownerships offers numerous benefits, it also presents certain risks and concerns. One potential risk is that institutional investors may have conflicting interests with other shareholders. For example, short-term oriented hedge funds may prioritize quick profits over the long-term sustainability of a company. Another concern is the potential for herd behavior among institutional investors. When many institutions hold similar positions in the same stocks, it can lead to increased market volatility and a higher risk of systemic shocks. Furthermore, excessive concentration of institutional ownership in a company may reduce its float, making it less attractive to individual investors and potentially impacting stock liquidity. And then we move to evaluating institutional ownership. When evaluating institutional ownership, it is essential to consider various factors, including the type of institutional investors, their investment strategies, and their track record. High quality institutional investors with a long term investment horizon and a history of successful investments can provide valuable insights and enhance market confidence in a company. Additionally, analyzing changes in institutional ownership over time can provide valuable information. For example, if reputable institutions are consistently increasing their stake in a company, it may indicate positive prospect for the stock. Conversely, a significant reduction in institutional ownership may warrant further investigation into the underlying reasons. Institutional ownership is a critical aspect of the financial market, influencing stock prices, market liquidity, and corporate governance. Understanding the different types of institutional investors and the potential risks and benefits associated with institutional ownership can help investors make informed decisions and navigate the complexities of the market. And then, how does institutional ownership work? Although many companies, particularly large blue chip firms, have thousands of individual stockholders, a select few of these owners will often hold the majority of the shares. These large institutional traders are typically well funded and routinely accumulate millions of shares of a single stock. Examples of institutional owners include corporate pension funds, college endowments, insurance companies, commercial banks, hedge funds, mutual funds, and boutique asset management firms that invest money for wealthy clients. On any given day, institutions usually account for the vast majority of the trading volume on major exchanges. When it comes to common stocks, institutional ownership is often expressed as a percentage of a firm's outstanding shares. This figure represents the percentage of a company's shares that are held by institutions. This information can usually be found along with a list of a firm's largest shareholders. And then, how institutional ownership can influence the value of securities? Because of the investment made in research, institutions are not quick to sell their positions. When they do, however, it can be seen as a judgment on the stock's value and drive down its price. Given the way institutions tend to approach stock ownership, by taking the time to accumulate the number of shares desired for its position, they might also react collectively to significant news. Not only will be trading activity be followed by retail investors, but the institutional investors might also retreat from a stock en masse if significant issues are discovered. Such a more could trigger a sell-off as the lack of institutional investor confidence weakens the securities value. The reputation of institutional owners can also influence whether analysts and fund managers at other institutions are interested in buying that stock. For example, if a firm well known as a momentum investor, some fund managers may shy away from buying stock heavily owned by that institution. However, if a firm has a reputation for choosing stocks that perform well over the long term, fund managers may be more likely to buy stock that is heavily invested in by that firm. I think that's enough for this session. Thanks for watching, and don't forget give this channel with your like, comment, subscribe, and don't forget share. Thank you.